Sometimes dividend investing is not the solution. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend growth investors, bonjour. Mike Leroux. You're listening to the Dividend Guy blog podcast. I hope that you are doing well. I am with my co-host Véronique, and today you're gonna surprise me with that topic. Like, what's going on, Vero? Are you changing your mind or something?
Well, I remember that's exactly what you told me when I said we should do an episode on that. So it may sound counterintuitive at first for you listeners, but stay with me a minute and I'll explain that. So we've been advocating for dividend growth investing since like 2010, but we're not here to contradict ourselves. We're here to clarify there are wrong reasons to invest in dividend stocks. And if you follow them, you likely end up disappointed, and we don't want that. So this episode is all about helping you understand how to use dividend investing the right way to build long-term wealth.
Yeah, because there is nothing black or white in finance. I always say there's no free lunch, but there's nothing super clear either. There's a lot of gray areas. And for the past 15 years, that has been like one of my top mission to explain what dividend growth investing means for me, which is slightly different than a lot of dividend investor. And this is what we're going to talk about today, like the different angles of dividend investing, maybe to explore a little bit more why sometimes it's not even working at all, like not even just not working that much, but could be a complete catastrophe for some investors.
So let's start with yield. Classic trap, right? You recently, Mike, described our approach as yield agnostic in a DSR newsletter, and I was like, oh my God, this is it. So what does that mean? And why is it so important for investors to move beyond yield?
The expression actually came from one of our member at DSR, and he said, well, he was trying to summarize the investment strategy from DSR. And he's like, so if I understand correctly, you're yield agnostic. So you don't care if a company pays a 0.5% yield or a 5% yield. And this is exactly it. Is the point of like dividend growth investing for me is to use dividend metrics as a new set of financial information that I can use to analyze a stock. So I use those metrics to complete the analysis, but I don't really care how much is the yield and how much is the dividend. What is important for me is I look at metrics such as the dividend growth trend. So if the company keeps increasing the dividend or not, because on the other side, a flat dividend payment for the past 5 years kind of tells you that the company is struggling somewhere. There's a problem. That's kind of like a one red flag, another one that you can identify quickly and then start researching what's going on there. I look for the same thing for the payout ratio and its trend. So again, if a payout ratio keeps on increasing, that kind of tells you that the dividend growth policy will eventually slow down or being paused altogether. And finally, I use the yield versus the historic yield. So I don't really mind if a company pays a 2% yield or a 4% yield, but if over the past 5 years, the average was at 2 and now it's at 4, kind of tells me, well, there's something going on here. Maybe there's a great opportunity because overall, in usual, the market will pay about the same price and get the same yield for a stock that doesn't change much. So if the business is the same, so assuming that the yield now goes up, that tells us that either the dividend grows a lot faster than the stock price, or most of the case, the stock price declines, and that's another sign that you should do a little bit more research for that. So to make it simple, the investment process is the combination of a good story, so the narrative around the business, why you like it, and good metrics. So when you have both together and you can add those dividend metrics to learn a little bit more about the business and the trend, well, then you have a good fit for a buy. So that's also explains why I do have companies in my portfolio paying like 0.2, 0.5, 0.75% yield, but I also have a few others paying like 3, 4, even 5%. And actually, I still have Telus that is above 6%. So as you can see, it's not about the yield, it's really about the process that is behind the investment analysis.
Right. So, just to make it clear, what are the risks of chasing yield and how can investors shift toward like a more reliable long-term dividend strategy?
Yeah, so I am known to be very reluctant when the yield is above 5%. And there's a reason
Mhm,
for that. There's no free lunch in finance. So people thinking, "Oh, I can invest at like 8%, 10%, 15%." And then we have like some investment products now offering like 20, 25% yield. There's something behind that. And not also to confuse yield and return. So I can offer you a 25% yield, but if the asset price goes down by 25%, your total return was absolutely zero. You just got your money back, but you didn't get
mhm,
anything else. So you have to be very careful about that. So there's, and going back to companies, there is usually a good reason why the company offers a high yield. And when you dig a little and you don't have to do like a 10-hour like research on the stock, you will rapidly see signs of a business that is mature at best, struggling most of the time. So with
mhm,
weaker metrics, a company that does not increase its dividend, that has a high yield, will likely show like no revenue growth, no earnings per share growth. And then you get closer and closer to this like big problem that happens to a lot of those companies is, and I mean history repeats itself altogether. At one point a company will cut the dividend. It's kind of like obvious, if it's not able to grow, if it's not able to make more profit, well, they need to save the business. They need to focus and put a little bit more cash flow inside the business to try to do something. And this is where you're going to get hurt by chasing yield without doing a proper analysis, or just narrowing down when you use a stock filter and discarding all the stocks that has a yield under 4%, for example. So
mhm.
the right way to do it is to focus on a set of metrics, not just the yield, but actually anything besides the yield. On my side, I'm known for following the dividend triangle. So the basic criterion that I will use are the revenue, earnings per share, and dividend growth rate over the past 5 and 10 years. And I look at the trends over that. And then a lot of people will say, "But Mike, it's all good. You're young. You're not my age. I need income." Well, what you need is total return, because you don't need income if it means that you're going to lose capital every year and you're just getting your capital back. I mean, you could invest $100,000 in a bank account, and if that bank account, like, you would draw $15,000 out of it, that's a 15% income. Well, not really, right? You're just getting your money back for until the bank account goes to zero. So I don't want that for a listener. And the ultimate focus to "I need income" will likely do that. Funny thing, I have sold shares of Apple several times, and that has been recorded on this podcast because Apple is my largest position. Every time it's
Mhm.
10% of all my portfolios, I trim a little bit. So I'm selling shares. So don't tell me that because you're selling shares, you're going to end up at zero, because I've done this 3 times already, and still Apple is the biggest asset in my portfolio. So even if I'm selling shares, the shares keeps going up. And of course, that's like one example, but just to show you that it's not because you're selling shares or selling units that your portfolio will go down to zero. Those units, those shares could actually go in value if they are a good investment, and you'll be able to keep on selling shares without any problems.
All right, the next one may come as a surprise, but don't expect to consistently beat the market every year by investing in dividend stocks. Like, what is a realistic performance expectation over time, Mike?
So there's that huge debate, right, between index investor and dividend investor, saying like one is better than the other for all kind of reasons on one side and another. And interestingly, if you look at most dividend growth or dividend oriented ETFs over the past 5 years, almost none of them beat the S&P 500. So it kind of tells you it's the wrong strategy. You're going to underperform the index, while the super easy way to do that would be simply to invest all your money in the S&P 500, close your eyes, and there
Right.
you go. So there are reasons first to explain why it's not beating the index. First, we're talking about like 5, 10 years period of time. That's not much. Thinking that your life as an investor will likely be between 50 to 70 years, 70 years, sorry. And the other thing is as of late, the S&P 500 returns has been driven by tech stocks. So the Magnificent Seven, like the Tesla, Amazon, Microsoft, Apple of this world, and most of them pay little or absolutely no dividend. So because
Mhm.
of that, they're not included in most of the dividend growth or dividend paying or high yield dividend ETF. So again, that doesn't change anything. I just told you in my previous answer, it's important to focus on total return. But the point here is more about, are you able to stick with one strategy with a high level of conviction? Long-term study shows that dividend growers and initiators tend to beat the market. So in general, it's a good thing to have those companies that keeps on increasing their dividend. And when you think about that, well, it only makes sense. If a business has more and more liquidity to increase its dividend every single year for the past 30, 40, 50 years, well, there is probably a good reason that explain that. It's because the business is thriving, it's doing well. If
Mhm.
not, it would not be able to afford to increase the payment. If the business
Right.
is going well, the stock price is likely going to increase and at least follow the index and sometimes even beat it. Even though it's not always the case, I still prefer to focus on dividend growers instead of buying the index, mostly because of conviction. So, my goal is not to beat the market all the time, even though over time, right now, I have like this case study on the blog, on the Dividend Guy blog. For the past 7 years, I'm doing it. So, that's fine. 8 years actually now. Wow, that's crazy. Time flies. But it doesn't necessarily mean that I will always beat the market. But what I love is I'm in full control and I know exactly what's going on. When I look at the S&P 500 going down by like 5% on a single day because Trump announced tariff back in April, there's no explanation for that. It's just like kind of crazy and I have no clue what's going on. I don't even know which company is doing great and which company is going to be affected by tariffs. But when I look at my 30 something stocks in my portfolio, I know exactly which one is at risk and which others are actually going to don't care about tariffs and will continue to do business as usual. So I
Mhm.
prefer to remain in control. So then over time, when the market fluctuates, when there are a lot of noise and uncertainties, I know exactly what's going on, as opposed to trusting 500 companies that I could not even list all of them by heart.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you, so please spread the love. Thank you. Okay, so we often treat dividends as safe, but they're never guaranteed. How can investors protect themselves from like unexpected cuts?
Yeah, that's a common misconception that dividends or distributions, even for other investment products, are 100% safe and they're kind of like due to shareholders. Keep in mind, management will save their job, save the company, and save your retirement in that order. So, probably that they're going to focus on their job. Most of the time, they will also manage the company right, but then they will not think about your retirement. They will not think about your income. They will just say, you know what, this is the best move to be made. We're going to cut the dividend, like increase financial flexibility, pay off debts, invest in growth, whatever. But
Mhm.
too many investors, I think, are blinded by those sayings like, oh, it's been around for years, it's been paying dividend for decades, it's not going anywhere. Well, those weak theses could lead to a cut easily. And the solution to avoid those cuts is to look at other metrics. Once again, the dividend trend, the payout ratio, the dividend triangle. If you don't put the numbers first and you prefer to focus on a sexy narrative, you're going to end up with a lot more bell than dividend growers in your portfolio. And that's
Mhm.
really unfortunate. But that's again going back to, oh, I need income. I'm going to chase yield and then dividends are safe because they've been paid forever. They're not. And keep in mind, a dividend that does not increase is also a passive dividend cut because ultimately, if you generate $35,000 in dividend from your portfolio today and you want to retire on this, Well, in the next 10 years, is the 35 is still $35,000 in 10 years? That's going to be a big problem for you. So don't tell me, oh, it's a high yield, but it doesn't cut its dividend. It's perfect. No, it still needs to increase to maintain your buying power.
Right. Okay. Another reason not to invest in dividends is to eliminate volatility. While dividend growers tend to be leaders in their industry and, like you've said, tend to outperform the market, they remain equities which are volatile. So, what mindset help investors navigate those ups and downs?
So the volatility statement is kind of like half true and half false. It's again not black or white, definitely gray
Mhm.
area. So on one side, the dividend payment will actually reduce the volatility. If your portfolio value is down by 10%, but you're receiving 4% in yield, well, your portfolio is only down 6. So you have reduced the volatility of your portfolio. Plus, the nature of dividend payers are usually like more mature businesses that have a proven business model. They count on reliable and sustainable source of cash flow. So most of the time, they will do better during market crisis. And this is usually what we see. However, it's not 100% volatility proof either. As you mentioned, equity is equity. REITs are actually the same. We're going to have like an episode on that. But I mean, it's not because you invest in properties that the business is not going to collapse. ETFs are the same. So they may generate dividend throughout a bunch of like strategies or whatever, but that doesn't mean that they will be super stable either. So what I prefer to do when the market is volatile, especially when the market is down, of course, because I rarely get emails when people see their stock going up by 8% in a single day. That's never happened. But when a stock is
Why
down by
not?
8% or 10%, oh my God, now I get flooded by like, what's going on? What happens? Can you tell me something? Should I sell? Should I hold? But I mean, when the stock is up 10%, crickets. So, anyways, but what I prefer to do instead, year over year, is to look at the dividend income that my portfolio generates. So, it's super easy to see that metric on DSR. So I open up my DSR Pro dashboard, I see all my portfolios combined together, and I see my dividend income. And the following year, I can look at the dividend income, and technically it should be higher. So when the market
Mhm.
goes down, but my income keeps on increasing by 5, 7, 10% every single year, well, there's something telling me that even though the market is going crazy, not feeling well, the company's doing good. The company's thriving. And it's not because the market is down. So we're always talking about the market, but that's like the whole index that is being down. Maybe I don't even own those companies in my portfolio, or they're not like big enough to have an impact. And I have like some companies doing well. So by focusing on the dividend increase makes your life a lot easier instead of thinking, oh, there are not going to be any volatility. No, I mean, if you retire today on $1 million, maybe your $1 million, even if they're all invested in blue chips, super stable, long-term dividend growers, that $1 million could be like 850 at the end of the year. And that's just normal. That's the market being the market. But if
Mhm.
your income has increased during that time, you have not only a sign that you should keep investing in this strategy, but you also have another sign that the business itself, even though the value on paper has declined, the business is doing great. The business is growing, it's thriving. And when the appetite from investors will come back and the market will go back up, those are the first businesses, those are the first stocks that will start to rise and recover.
Okay, the next one is investors should not invest in dividend stocks to recreate an ETF. And we've seen that a couple of times. So that means like to select 60, 80, 100 different companies and then have a hard time following them. So when investors try to hold like 40 plus stocks, it starts to look like a DIY ETF. What are the risks of over diversifying like this, Mike?
So the idea of having like all the stocks per se is actually to diversify to a point where if there is a dividend cut, but that company is like 0.43% of your portfolio, you don't really care about the dividend cut. And I totally get that. That's like kind of like the
Mhm.
ultimate diversification. So you don't want to lose too much on a bad stock decision. So by having like 100 stocks, it's almost impossible that your portfolio is going to crumble and die. That's kind of like the idea behind that strategy. The big risk, in my opinion, though, is the fact that you will not be able to follow every single companies. Therefore, Yes, if a company fails you, it's going to have a smaller impact than myself with like 30 something stocks in my portfolio. But the problem is your likelihood of making those mistakes because you skip the quarter, you become complacent, and then you're just thinking, oh, I don't care. It's 0.43% of my portfolio, anyways. Well, that increases the likelihood of having bad companies in your portfolio. And
Mhm.
even if you did your research at first, and we did that not too long ago when we reviewed telcos on the show, Bell was a great company for decades, not a few
Mhm.
years, for decades. Great business model, recurring cash flow, everything super stable, operating in an oligopoly. There was a lot of things to love about Bell. So if you did that analysis in 2012, you may have thought that's a great company to own. So you buy it and then you forget it. Well, fast forward today, not such a great company to own anymore. But you cannot realize that if you do not follow every single of your holdings, looking at the narrative, the investment thesis that you made with the numbers. So if you're just going with the flow, thinking that a wide portfolio with 100 stocks will do it, well, this is the risk that is lying around. So if you are passionate about the stock market and you actually it's your hobby to follow those companies, then it could work. But if you're not able to track those businesses every quarter, be careful with this. You're going to skip more than someone who managed a portfolio at 30 stocks and is actually on top of everything that is happening with those businesses.
And I mean, if you have like 1 or 2% bad holdings, that adds up. Like if each of these assets are 1 or 2% of your portfolio, then it ends up being like 10, 20% of your portfolio, right?
Yeah, and at that point, I mean, you might as well just buy an ETF and save yourself all that trouble.
Right. So, what's a healthy number of stocks to manage effectively without diluting your focus?
I kind of like the number between 20 to 40 stocks. And from my private banking days, where we met with professional portfolio managers, those managing like tens or hundreds of millions. So they'll tell you that you have a large portfolio and this is why you need 100 stocks. Most of the time, they never went above 40 stocks, like most of them. Of course, there are some exceptions as usual, but many of them, they were quite comfortable with a mandate focusing on 30 to 40 stocks, and they had like $100 million in their fund to manage. But that was the point. I mean, again, to each their own. If you prefer still to track down all those companies, it's good for me. But between 20 to 40, you have enough for having a good diversification. So investing in several different industries. And at the same time, it's not too much time required every quarter to monitor your portfolio. I have about like 33, 35 stocks in my portfolio. I do that full time. And I don't spend that many hours looking at my portfolio every quarter. It's just like a routine check. From time to time, there is a red flag. I study it, I dig a little bit further, and then I take
Mhm.
action. But most quarters, that's just business as usual, just making sure that I tick all the boxes. And once it's done, I can move on with my life and do something else.
So, in the same train of thought, your dividend portfolio should be diversified across many sectors or industries. Don't buy dividend stocks thinking it will make a play in a specific industry, like 10 or 20% in a single stock. What's the danger of focusing too heavily on one sector?
So this one is not just related to dividend investing, but in general.
Mhm.
And I've seen that so many times. So, we are doing private webinars monthly with our members, and I also do public webinars. And in all of those, there is a Q&A period. And during that Q&A period, it's like more than that in an hour. I get like 50 to 80 questions. And from time to time, we get those questions of, oh, I want to make a play on copper. I want to make a play on electric vehicle. I want to make a play on
Right.
cannabis. I want to make a play on artificial intelligence. And when you focus on a single sector, think first, whatever you're thinking is probably coming from something you read or you listened to. So
Mhm.
that's almost public knowledge. So you're not the first one thinking that copper is the next big thing. And actually, that's just a thesis. It's not even 100% sure that it's going to happen. But even then, many people think the same way. If you're thinking that you just tried something magic now and then you're going to be the only one making it like 100% return on your investment, probably not. The second thing is when you use a stock screener to filter down your research, chances are you're going to find several companies in one good looking sector at the moment. Because It's
Right.
all about the economic context, of course. So if you're looking at a stock screener while consumers have like a high level of confidence, they have like low debts, and they want to spend a lot more money, well, consumer discretionary, for example, those companies will likely show up on your screener. But if you buy like 10 of them, well, you're just concentrating your risk into a specific market event. And if there's a recession, you're going to get hurt big time. So instead of trying to buy an entire sector, an entire industry, buy a few companies that stand out of the crowd. And by doing this, you will avoid having a strong concentration in a specific sector, because most of the time when there's a big market crisis, it always starts from one specific sector. So imagine tomorrow morning that we realize that every company is using AI for one reason or another. It's completely flawed. And that AI thing is like destroying value instead of like increasing profitability. We would have like a big tech crash. Well, if you have like 50% of your portfolio in Nvidia, well, you're not going to like that, right? So
Mhm.
that's why it's important to be a bit more diversified. And yes, it's okay to have stocks in something that you believe in. Just don't go overboard with that. So I've been saying for the past 2 years that I identify a few stocks in my portfolio, like some position that I added, that are aligned with the fact that there's more and more money invested in building new infrastructure, replacing old existing one in North America. I'm
Mhm.
not trying to transform my portfolio and put like 30% on that play on infrastructure. But when I make a research and I'm looking to add a position, this is something that I have in mind. So I have a little bit more chance to add an equipment company or an engineering firm to my portfolio for that reason. But at one point, I don't want to transform my portfolio or sell like 15% of it to move it toward what I think is going to be a good trend in the future. That trend is only one small part of the investment thesis. I need other growth vectors and I need strong metrics to validate that choice instead of just
Mhm.
going, oh, I'm going all in cannabis.
Listeners, let's empower you in the investment world with our free dividend rockstar list, which includes stock ideas with positive dividend triangles. How does the list help investors, Mike?
Vero, we survey regularly our members and our readers, and we ask them what are their biggest struggle. And one that keeps coming back is really the buy struggle. Most investors don't know what to buy, they don't know when to buy it, and the Rockstar list will help them grow a little bit more their conviction, because that list of stock will just include companies that show great financial metrics. Of course, you cannot start by picking them blindly, but it's a pretty good start to make sure that the company that you're about to read and know their business model is actually a business showing revenue growth, earnings growth, and dividend growth. The way I use it usually is I will filter it by sector to identify a sector that I want to have more exposure to, and then I just look for companies that have the strongest dividend growth model.
To download the list, enter your name and email at thedividendguyblog.com/rockstar. Again, hit pause now and go to thedividendguyblog.com/rockstar. Another thing that we sometimes see is investors changing or mixing strategies. You should not invest in dividend stocks because it's the flavor of the month, or because your neighbor does it, or because you're lacking conviction in your current plan. So, what are the risks of mixing multiple strategies like BTSX, ETFs, and dividend growers without a clear plan?
Well, the first thing is, I love to compare investing with cooking. So it's not because you have like a dozen great ingredients in your fridge and in your kitchen that you should put all of them in the same soup. Maybe it's gonna taste weird. Maybe you're not gonna get the expected result. You're right. I hear that a lot from investors. Oh, I'm doing a little bit of the beat of the TSX. What do you mean you do a little bit? So sometimes when it suits yourself, you're going to pick a high yielder that did not perform well in the TSX. Is that it? Well, it's all right, but don't expect to actually have the same results of the beat the TSX, because to
Mhm.
get those results, you need to follow a very strict set of rules. You need to reframe your portfolio every year, sell everything that is not on that list, and buy everything that is on that list every single year. If you're doing anything else than this, you're not doing the beat the TSX strategy. So you may tell yourself you're doing a little bit of this, but that's going to just create confusion and it's not going to give you the same results. The expected results are not going to be there. And eventually, another thing that I've seen several times is to over concentrate thinking you're doing some diversification. And a good example is I saw a lot of investors investing in those all-in-one ETF that I really like because they're covering everything. So someone will invest in XCQT, for example. And XCQT is investing in equities across the world. So
Mhm.
in the US, in Canada, and outside of it on the international market. But the concentration is 45% roughly in the S&P 500. So for someone who's invest in XCQT and then say, oh, I'm going to buy some QQQ, which is tracking the NASDAQ, and then a little bit more of VFV, which tracks the S&P 500. Well, for a diversification play, well, the only thing you're doing is actually you started from 45% concentration in the US and now you're at 75%. So
Mhm.
you just first you bought exactly the same thing that you already own and you just increased it. So if your goal was to have a portfolio with 75% invested in the US stocks, that's fine. But if your goal was to diversify your portfolio, that's a big fail. You just concentrated instead. So trying to mix a few things here and there sometimes is going to get you lost. And again, if you have like a base of ETF and then you're buying dividend stocks because you like the income, just make sure that you look at the top holdings of your ETF. Maybe they are holding exactly the same thing that you're going to buy. So,
Right.
especially true on the Canadian market because the common suspects are known, right? I mean, you have the telcos, you have the banks, you have utilities, you have the pipelines, some energy stocks. Once you did that, life insurance companies, I mean, you got like 50% of the market already. So it's kind of getting hard to find other type of businesses that will not be in a TSX index.
By the way, listeners, we've mentioned Beat the TSX, we've mentioned my dividend income portfolio, and we've also mentioned like webinars. So just so you know, I will put the link to all of those things in the show notes at thedividendguyblog.com/232. So Mike, bringing it all together, what's the right reason to invest in dividend growth stocks?
So the right reason is for someone who has a minimum of time, a minimum of interest, and a minimum of knowledge to first start considering managing a portfolio of stocks, dividend growth or not. Because if you don't have time, interest, and knowledge, you're just going to follow someone, think, oh, they're going to do the right thing, but you can borrow someone else's ideas. You cannot borrow his conviction. So it's important to put a little bit of work here. So if you're willing to work, and it doesn't need to be that much. I mean, this is what we do at Dividend Stocks Rock. We
Mhm.
support investors in that research. We guide them to build an investment thesis that makes sense. We highlight the risk. We do webinars, we write newsletters to help those investors that have actually a minimum of time and interest to learn and boost that knowledge so they can invest in dividend growth stocks. But the real power behind it is to be in control. So, dividend growth paying companies are companies that are doing well, at least, and probably thriving because they are increasing their revenue, they are increasing their profit, they are increasing their dividend. So,
Mhm.
when you select companies in that basket, well, your likelihood of doing good is pretty nice. It's probably like, I don't know, 80% chance of not necessarily not making a mistake, but having a global portfolio that will guide you through retirement. If you go for another type of strategy, make sure that you really understand what's behind it, how it works. And if you're not able to explain that to a 12-year-old, don't say it's too complicated, you cannot understand it. Well, that means that it's also too complicated for yourself and you may be
Mhm.
up for a big surprise. So, being able to understand what you're doing with your money is key. If you want to be in control, dividend growth stocks is a great alternative. If you just want to buy an index and not even have to think about it anymore, that's working too. But whenever that portfolio goes down by 15%, you should also not ask yourself any question and stick to the same strategy.
Mike, you recently created the DSR Investment Road Map to help investors build a solid portfolio. We decided to make it available for you, listeners. Why should they download it, Mike?
Well, that roadmap will be a great use if you think there is too much noise, too much information in the market, that you always think there is a market correction around the corner, that you hesitate to start investing, or you have a lump sum of payment and you're not too sure when is the right time to get your money working for you. So it's a step-by-step program that I developed, like a few pages, easy to read, but it's going to give you a framework where you can actually start buying stocks, getting your money working for you. And you won't be able to do that without rules, without having a process. And this is exactly what the DSR Investment Road Map is. The idea came up after a discussion I had with one of my members that had like a large sum to invest. And then I thought, how about I make you that roadmap so you know exactly how to make your decision? So I'm not telling you what to buy in this booklet, but rather
Mhm.
how to create your investment process. That may be a bit different than mine, but at least you will have the conviction to stay invested.
So, listeners, it's time to invest for good reasons and with a solid plan. Enter your name and email at thedividendguyblog.com/roadmap and get it for free now. Thank you, Mike, for once again adding clarity to dividend growth investing. Listeners, do not leave without your investment roadmap. Visit thedividendguyblog.com/roadmap now to download it. For our show notes and related content, visit thedividendguyblog.com/233. Next week, we will hit the real estate industry with Daniel Fush. It was a pleasure to have him as a guest and gain another perspective on REITs. Make sure you do not miss it. Hit the subscribe button underneath our podcast logo and leave us a 5-star rating. Until then, stay invested.
Stay invested.
Hey fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.